Welcome to Module 3. So in the first module we looked at an overview of what investments are and how they're accounted for, how they would be recorded as transactions, how they would be recorded in the financial statements, and just some basic issues. An overview. In the second module we looked at some current valuation controversies. Specifically, we looked at the mortgage-backed securities debacle in the United States beginning in 2007-2008, and the sovereign debt crisis that is ongoing as of 2011, but has certainly been going on for the past year or so. And so here we are in session 3, and in session 3 we want to look at again an overview of the specific issues related to valuation and how we categorize investments and what we could do with them and what the accounting for them could be. And so I think to do this, we want to develop sort of a classification system for thinking about investments. And so the first thing that we want to think about is the intention of management. When they're holding, the management of some company has bought some investment securities, and investment securities can be sort of one or two types in general. We could buy equity. In other words, usually we could buy the stock of other companies, right? Or we could buy debt. And that's usually, not always, that's usually bonds. Remember that bonds are like United States, individual debt contracts, each one valued with a face value of $1,000 that promises to pay interest at a certain rate, and when they mature at some future date you get back $1,000. But in between the date that they're issued and the date they get, the date of maturity, which might be 5, 10, 15, 20, 30 years, the price of the bonds might go up or down based upon prevailing market interest rates and the relationship between that and the coupon or cash interest rate that the bond pays. So the value of the bond may change over time, even though the bond will always promise to pay back the stated coupon cash rate of interest, 4%, 5%, whatever it says, it stays the same, as well as the face value when it matures. But if you buy or sell in between, you could buy or sell at any price. So for example, right now, if you were to go and buy, for example, U.S. government debt, many of those were issued several years ago at, so I don't know, 6, 7, 8, 9% interest. That was the coupon rate. Right now, what are interest rates? Maybe 2%. So guess what? The values of those are really high. They're much bigger than $1,000 because everybody would like to get 7%. And so basically what happens with these bonds, the bonds get priced so that the effective interest rate that you earn on owning the bonds is equal to the market rate of interest for similarly risked securities. So anyways, I don't want to get into that in too much detail other than just to remind you about what bonds are. And so these are the two kinds of investments that could be made. Investments in stock or an investment in bonds. So that's sort of issue Roman numeral 1. Issue number 2 is our intention to hold. We kind of divide that, we sort of categorize that. I'm not sure that this is the perfect way to do it, but here's how we sort of think of it. We say we're ready to sell. So we're just doing this for a little while, and when we think it's a good time to sell, we'll sell them. Then there's other ones that we're really not planning to sell. But we might. If the price is right, we might. And then there's a third group these are not planning to, is we're basically, we will not sell. This might be a little bit of an oversimplification, but it'll serve us well for the way we want to look at things. So we've got the, you know, the kind or the type. The type of securities could be equity or debt. The holding intention, which is either to sell them when the price is right, or, you know, maybe not, or we're just going to keep them until they're mature. And then the other issue is one of control, or maybe ownership percentage is another way to think of it. And so we basically divide that into threes as well. And so we can say it's you know, it's very small. Like, for example, if you own a few shares of Apple Computer or IBM or some other company, it's nothing that has any issues related to control or influence whatsoever. So that's his first category. And then there's others which are, you know, we usually say, is a general rule, but we say when you get to about 20%, you know, somewhere to 20 to 50%, we say that there's some significant influence. But it's not like you have a controlling interest in it. Now, with many big companies, I guess you could say that even 10 or 12% might be enough to effectively control a company if you have a sufficiently dispersed ownership of the rest of the company. But nonetheless, at least mathematically, this is something that you can see, and from a generally common sense point of view, it certainly is some degree of influence, but not an absolute majority controlling interest in a company. And then there's those that are, I don't know, 50.x plus % ownership, which we say is like a controlling interest. So this is how we categorize our investments, and you can kind of imagine like a three-dimensional space. We can actually break it down because of the way I can do this. We can sort of ignore this first one here because of the way I've broken this down, and we can sort of have like a two-dimensional space, and basically, in other words, just like a big matrix where we can look at the accounting issues, the accounting treatment, and the financial statement disclosure related to what our holding intention is and what our control and ownership is. Now, the reason I can get rid of this one here is because the way that number 2 works, if you look at your texts, you know, this is called, we have some separate phrases for these different kinds of investments. And so, I'm trying to remember what the page number I have for you on this thing is. I don't actually remember. Anyway, so the ones that we're looking at here are trading securities. These are marketable securities, what we think of traditionally as marketable equity securities, stocks that we own, that we're just putting some money aside to get some extra returns because we don't have anything better to do with our money, and that we're going to sell as soon as we can. So those are trading securities, and this is a short-term equity investment. And then we have available for sale. And these are equity securities that we might sell, but we're not planning to. And then we have held to maturity. And these are always considered to be bonds. There's actually some special and separate accounting that we use for investments in bonds that you may recall we talked about in class in dealing with the premiums or discounts on bonds when they sell for more or less, or we buy them for more or less than their face value that actually relates to this. But that's okay, because you're going to see that things work out really nicely. So anyways, we can sort of collapse 1 and 2 together in our criteria here. And so what does that mean? So down here we could have one axis that has our trading securities, and another one that has our available for sale securities, and another one that has held to maturity securities. And then along here we can have these. What is the percentage of our ownership? Its percentage is small or significant or controlling. And then what we're going to put in the boxes here is just what do we handle? How do we handle the accounting for this stuff? Okay, so let's kind of think of this in terms of looking through these different categories, because it's the percentage of ownership has a lot to do with this. So first of all, if we look at trading securities are things that are investments that management intends to sell. They're actively engaged in buying and selling them. And trading securities are going to be reported on the income statement as unrealized gains and losses. So, if the value of a trading security goes up, so if we have let's assume any of these securities, suppose that the cost is 10 and it's worth 12, we've got an unrealized gain of 2. And what happens with that 2? If it's a trading security and the ownership percentage is small, we're going to treat that as an income statement item. It's going to go under other gains and losses, and we're going to call that an unrealized gain or loss. Now, that means we're able to adhere to what we would call the clean surplus rule, which means that anything that gets to equity has to go through the income statement. Now, the available for sale securities are a little bit different, because if we look at the available for sale securities, they bypass the income statement. So what we do is we show them as a special adjustment to equity. So whereas if you think of where you would think of the accounting equation assets equal liabilities plus owner's equity, we've got a retained earnings column in here that includes gains and losses. That's not where the unrealized gains and losses on these available for sale securities go. They don't go on the income statement. They don't appear there anywhere. They're a special adjustment to the owner's equity section. They're considered to be a part of what accounting euphemistically calls comprehensive income. But it doesn't show up in the income statement. That's the important thing to remember. It's not part of the income statement. So we would still say, okay, well, we're going to show it. Yeah, we're going to show it. If it's an available for sale investment, we will show it. But it's a non-income statement unrealized gain or loss. So in other words, what does that mean? On the balance sheet, that 2 will be shown as having the investment will be bigger. So under trading securities, we'll show an extra 2. Under available for sale securities, we'll show an extra 2 under investments. But under the trading securities rule, the 2 also shows up as an income statement item, whereas under available for sale, it's just a special adjustment to equity. All right? Then, when we're dealing with held to maturity, which is just basically bonds, we're just going to use our cost method. So we're not going to do anything when the value goes up or down. We actually have some special rules related to that you can look up and that are in the text and that you recall related to how we handle premiums and discounts. So when we do amortization of premiums and discounts on bonds, we're basically doing an adjustment related to the difference between the market rate of interest and the coupon rate of interest, and so that's how we handle it. It's just handled differently. So this is for small investments, all right? I can sort of put this can kind of get combined down here like this. So when we look at held to maturity, it really doesn't matter. It really doesn't matter how much of what percentage of the bonds we own. bonds are really not an ownership element in a company. So whether